Wealth and Wisdom is brought to you by the Johannesburg Stock Exchange.
Hello again, I'm James Boardman. Today we're looking at government debt markets, how they work, and ultimately what it means to you as an investor. And in this picture, government debt, inflation, and central markets. So most of the shows on Summit are about equities. The truth of the matter is that bonds are actually a much bigger market. That has a huge impact on the economy and the stock market. So we often hear about them in vague terms of yield and interest rates. So to really get to grips with this, we need to understand the basics of bonds. So we've got to look at their history, their origins, and how they affect the world today, and how they're priced. Bonds have had a huge impact on world historical events, in that having cheaper and better financing has often enabled a side to win the war. The American Revolutionary War was funded with lots of money from France. The British managed to survive World War II with the generous assistance of the Americans through the Lend-Lease program that was set up by John Maynard Keynes. The British managed to survive the long and very, very costly Napoleonic Wars through their superior financing system and their government bond market. Now, at the moment, around the world, we are having a global debt crisis. Governments basically have borrowed too much money, and this puts us in quite a tricky situation. The numbers being thrown around are terrifying. We hear in the news about Spanish government bond yields hitting 6%, or Italian bond yields hitting 7%. So what are the implications for the world economy and the Eurozone? Governments have always needed money. Most of the time, they raise money from taxes. However, quite often, especially during wartime, the government needs more money than can be raised by taxes in a particular year, so it will resort to borrowing. In ancient Rome, there were several cases of very rich individuals making loans at interest to the public treasury, often to pay for wars. Now, in the Middle Ages, there are many cases of loans being made to governments by bankers. Problem is that then the bankers are the biggest creditors to governments. Creates a very, very tricky, tense situation at times. I mean, in the French king, years and years ago in the 1200s, borrowed huge amounts of money. Then he went and persecuted all the bankers. Because he'd borrowed so much money, he didn't know he'd be able to pay it back. That led to the sacking of the Knights Templars' sort of inner sanctum, and there was huge political turmoil around that. Now, the first tradable bonds are recorded as being in Venice in the 1400s. In those days, Italy was made up of lots of small and independent states. One of the most prosperous, innovative, and enterprising of these states was Venice. Now, Venice is built on a marsh in the middle of a swamp, very poor farmland, no mineral wealth. So they needed to make money in other ways. The main way their economy succeeded was trade. They made amazing glass, and they traded all over Europe, and they made a lot of money doing it. And that's those incredible cathedrals and piazzas and stuff. That was all built with Venetian trading profits. Now, one of the first Europeans to ever go to China, I think he was possibly the first ever, was Marco Polo. He was based in Venice, and he was looking for new trading opportunities. To trade, it required the use of large ships, but they cost a serious amount of money. They took time and skill to build. It was also a very risky business, so you didn't want to have all your eggs in one basket. I mean, if you read Shakespeare's The Merchant of Venice, they talk about the risk of the guy's ships not coming in, and I think it's Antonio who's almost ruined because his ships don't come in, and some of them crash, and some of them are taken by pirates. So an incredibly lucrative but very risky business. So to finance the building of these ships, they innovated. They created amazing new methods of financing. This led to some of the modern banking practices we know of today. So in 1157, the Venetians were fighting the vast and powerful Ottoman Empire for control of some of the sea routes of the Mediterranean. They needed to pay for a new fleet of ships to fight the Turks, so the Bank of Venice raised government bonds to pay for it. Now, the Venetian currency was called ducats. They were small gold coins, and these bonds paid a coupon, which was a regular amount based on the value of the bond. So they offered two kinds of bonds. One was a perpetual, which paid out a certain amount of gold ducats each year in perpetuity, but never paid back the principal. That's much like a pref share. You just earn interest on it every year, but you never get back the principal until you sell out to someone else, sell the perpetuity on. Now, the other kind of bond would be paid back with the principal amount in the future, and the interest payments would then cease. That's then a capital repayment event. Now, current bond markets rely on a rollover. A lot of the time, they don't have enough money to pay back their initial investors, so they hope to find new investors to take on their debts and agree to be paid an interest rate in the future. Now, in Venice, these bonds they had enabled them to build a large fleet, and they managed to protect their trade routes. So tiny Venice took on the huge Ottoman Empire. Now, there's a fascinating story about government bonds. Sadly, it looks like it's now being debunked, but we just love the story so much, and it's sort of passed into common legend, so I'm just going to share it with you. Now, in 1815, the British were fighting the French at Waterloo in Belgium. Now, they'd suffered a defeat at a little battle just before that, at Quatre Bras, that means 4 arms, a few days before. Now, the British hopes they were looking poor. Now, Napoleon, if he won, Britain would likely lose the war. The government would be far less likely able or likely willing to be able to pay back all the money it had borrowed using the bond market. So soon after the battle and before the news got back to the market started to plunge. Nathaniel Rothschild, the most feared and admired financier of that era, sold more bonds. The market panicked. They saw him selling. They could see it was his agent selling. He always had an inside track because he had an amazing intelligence network. He had spies. He had carrier pigeons. He was incredibly advanced and sort of almost insider trading on news before anyone else knew. So everyone feared the battle was lost, and he went out and sold and sold and sold. As the market crashed, he went back in. He bought back all his bonds at a very low price. He bought back more bonds than he'd even sold, and he made a fortune. He heard before anyone else that the British had prevailed. Now, after the break, we're going to follow up and see what happened with that Rothschild story. We're going to learn a little bit more about government bond markets.
JSE Safex style options, a great choice.